Hey everyone, it's Professor Reiko. Another quick little video here in our equity chapter. And this is on the basically how we handle stock issue cost. All right, so when we issue stock, there's obviously costs that go into that. All right, and how we handle that is we debit those costs to additional paid-in capital or the paid-in capital in excess of par account, and then we reduce the amounts paid in, meaning the cash. Okay. So typically when we issue stock, we collect cash and we'll end up having a credit to additional paid capital to kind of catch the difference between par value and par value and what we issue them for. All right, and means we're just going to back some out of that. All right, so we issue 100 shares of $10 par common stock for $17 and incur 300 of issue costs. All right, so there's two different ways to do this. I'll show you both. So you can do it as two separate journal entries, and some, I'm a believer usually in do it as as in as few journal entries as possible. But I think in this instance, it might be a little easier to see it as two journal entries. All right, so what I mean by that is let's just take the issue and then the issue cost as complete separate entries. Now they're happening at the same time, so they all net out. That's fine. So, but here's what I mean by that. So we know that when we issue stock, we're going to debit cash, credit common stock. And in this example, like most of them, we're going to have additional paid-in capital common stock. All right, so it says we have 100 shares that we issue for $17, so that's $1,700. All right, our common stock par value is $1,000, $10 par times 100, which means the additional paid-in capital is $700. All right, now let's handle these issue costs in the second journal entry I'll do down here below. It says debit our additional paid-in capital account for the 300 issue costs and reduce the amount paid in. So almost handle it as like a separate payment. All right, so that is fine. That kind of breaks it up into one journal entry for issue and one journal entry for issue cost. If you want to net these together in one journal entry, it's fine. It would just be a debit to cash for the 1,700 less the 300. All right, our credit to common stock would still and always is par value. And then our additional paid in capital would just be the original 700 less the 300 issue cost, so for 400. All right, so if you look at those together, you can see they net out to be the exact same thing. So however you want to do it's fine. I always tell my students I would accept either on a test. Kind of pay attention to what your teachers, how they're teaching it, and see what you like, and just make sure you're doing it in a way that you're going to get full credit for. All right, so just another small little video here on issue cost. We're going to switch gears next time and go to treasury stock. So that's when we start buying shares back. So these first four videos have just been kind of introducing common stock, looking at a couple of different situations that could happen when we issue that stock, and then also the cost of issuing those stocks. So now the way you got to look at it is we have stock that we've issued and it's out there. Now we're going to start buying it back in the form of treasury stock. So that will be our next video. All right, so tune in next time as we get it going on to treasury stock, which is one of the bigger topics in this chapter. So I'll see you next time. Thanks.